Hello, everyone. Thank you for joining us. It's going to be just a moment before we get started. I'm going to let everybody trickle in and get settled. Today is a lunch and learn, so please, I encourage you, sit back, relax, have a sandwich. It's going to be a quick 30 minutes of education. We're all very thankful that you took the time to join us today. Ooh, look at all these people coming. Some faces I know, some faces are new. If this is your first time joining us, welcome. Just a quick minute, we'll get started. Hello, Adam. Hello, Brett. Thank you all for coming. A few housekeeping items before I jump in. If this is your first Zoom webinar, you will be able to find the controls for your Zoom either at the top or bottom of your screen, depending on your device. There you will see a chat feature. I encourage you, if you have questions throughout the presentation, to use the chat, as we have disabled the ability to have you communicate via voice. It keeps distractions low and allows the presentation to flow and honor your time, this quick 30 minutes. Any questions posted in the chat will be viewed by our moderator, and if we have time at the end of the Q&A, we will get to them, and if not, I will ensure that somebody will get back to you to answer your questions after the presentation. So I want to start today by saying again, welcome. We are here to talk about corporate capital strategies, creating wealth, and your host today is going to be Andrew Stafford, the president of Prevail. Andrew has been working with Kerry since 2013, back in Lawing Financial days, and is one of the original founders of Prevail. Many of you who know Andrew in person know that he is an incredibly humble and passionate person, but he is uniquely qualified today to talk to you about corporate capital strategy because he has lived many of the situations that we're going to discuss. He's the fourth generation of his family to run a family business, and the things that he learned taking over that company and his continuing education he's had throughout his career makes him uniquely qualified to be an expert in this arena. Andrew hasn't presented in more than a year in a group setting with Prevail, so this is sure to be one of the best that we've had in a long time. No pressure, Andrew. But without further ado, I do want to kick it over to Andrew Stafford, president of Prevail.
Thank you, Susie. Welcome to Corporate Capital Strategy, Creating Wealth. I'm Andrew Stafford, president of Prevail. Today, we're going to talk about one of our strategies that helps small business owners transition their mindset from creating a lifestyle to true wealth creation. So we work with small business owners all the time, and there are generally a multitude of challenges to owning a small business. But what we have done is we've identified 7 kind of business capital pitfalls that is common amongst most small business ownership. Today, I'm going to focus on 2 primarily, which is business concentration risk and what we'll refer to as the trapped wealth. Now, I had an amazing opportunity to grow up in a small family business. My great-grandfather in 1926 bought the rights to distribute the Kansas City Star newspaper to all of Missouri. I was the 4th generation to take that business over. And as you can imagine, our mindset was that this business was recession-proof. Unfortunately, we didn't utilize the good times to prepare for the bad, and we used capital to create a lifestyle, not true generational wealth. And then along comes the digital disruption. And after 74 years of being in business, albeit an amazing one, I was also the family member that had to shut that business down. So what does disruption look like for you? How prepared are you in your business for the next economic downturn? We're actually in that right now for a lot of us. So when you look at the current situation, I think it's important for us to all take a step back and look at our business to say, what would have happened had the PPP loan not been injected from a capital standpoint into our business? How liquid or prepared were you for a elongated downturn? I know for a lot of our clients, that was a savior. Now, after I shut down our small business, I had the opportunity to go work for a very, very large organization. And it was amazing to see the difference in the way that they viewed capital. So capital inside this business was used to diversify, create additional revenue streams. It actually de-risked the business versus creating a lifestyle. It removed potential liabilities in everything that we did. And most importantly, it helped us leverage economic chaos. The access to capital and the liquidity inside the business allowed us to take advantage of economic downturns versus being a victim of economic downturns. So I took my opportunity to have those two great experiences, albeit different, and I transitioned into the financial services industry years ago because I wanted to take my lessons learned and bring those to small business owners so they didn't make the same mistakes. So today we're going to talk about one of Prevail's unique strategies of wealth creation for small business. Now, your particular situation, I can promise you it will be different. But what is most important is the transferable aspects of this from a strategic standpoint, not so much the numbers that I utilize and or the industry that I'm going to refer to. So this was a trucking company, and about every 3 years, he would buy new trucks. Now, you may ask yourself, initially, I thought, why buy new trucks every 3 years? Is it for depreciation? It was actually because he couldn't keep drivers because the job market was so intense. He couldn't keep drivers if he didn't replace the trucks and have them in new equipment every 3 years. So sometimes he would pay for it out of cash flows of the business, and sometimes he would borrow, finance at the local bank, and he spent about $1.5 million every 3 years. And there was no rhyme or reason as to why he would either pay for it out of the business and or finance it. But what was unique is as we started to talk to him about his particular situation, whether he financed it or he used cash flow, he always ended up at the same place, was back at zero. Now, he had the asset, but he was transferring wealth outside of his business, either through opportunity costs by saving the cash and or interest costs to the bank. So we talked to him about doing what he's already doing today, but leveraging it to a greater return, utilizing capital differently. So let's go through the process. Again, this was a highly profitable business. Over a 10-year time frame, we transitioned $1 million a year out of the business into what we'll refer to as the wealth creator. Again, it wasn't an expense, it was an asset transfer over a 10-year period. Now you may ask yourself, why utilize this particular financial instrument? Well, it's very important because it's liquid, it's not stock market related, which again, doesn't add additional risk. You take risk inside your business every day. Your investment strategy shouldn't add additional risk. And most importantly, it transitions the assets into a tax-free environment. Now, I want to point out a very important aspect of this particular investment vehicle. Notice in line 14 how we're at $12.5 million in cash value and roughly $21 million in death benefit. So this is a fully funded policy. He can only put money in for 10 years and it's paid up. He's made no adjustments to it, and the cash value grew to $12.5 million and $21 million in death benefit. So let's talk about how he actually leveraged this. So the policy was used to infuse capital back into his business, just like he was before, whether it be through his retained earnings cash flow and or the financing of the business or of the trucks. So in year 2, we showed him how he was able to use $700,000 out of the policy, roughly half of his 1.5 that he was utilizing every 3 years to purchase these trucks. He paid himself back over the 3-year period with interest. By year 6, we showed him how he could double his expenditure, take it from 1.5 to 3 million, pay himself back over the same 3-year time frame, and by year 10, we showed him how he could utilize $9 million. So over a 10-year period, when he transitioned the assets out of the business into the wealth creator, he was able to infuse $12.7 million back into the business and repay himself with interest. Now, if you'll go and remember what was important about line 14, $12.5 million in cash value and $21 million in death benefit. That's what's amazing about this vehicle, is because he paid himself back with interest, the asset grew as if he never utilized the money. This is one of the only investment vehicles where you can leverage the dollars. You can actually deploy them into whatever's going to give you your greatest return, and the asset will still grow as if you've never deployed it as long as you pay yourself back with interest. So as you can see, year 14, just like the previous illustration, his gross cash value and net death benefit have equalized. Now, let's talk about how this truly levers up. So we talked about the $10 million asset transfer from the business into the policy. But what is amazing about this is now the business owner is able to pull $823,000 tax-free per year for the next 20 years out of this particular policy. So he's able to pull $16.5 million tax-free. Think about the rate of return you'd have to have in an investment account that is pre-tax in order to generate $16.5 million tax-free. And by age 90, he still has $6.5 million in death benefit that can be utilized for his legacy. It could be utilized to pay estate taxes. It could be utilized to inject capital back into the business, let alone the fact that he was able to inject $12.7 million back into his business while he was transferring this policy out. This is one of the greatest tools to lever up and create wealth that we've ever been able to implement with small business owners. So the next thing that we look at is we started our conversation with talking about some of the common small business capital pitfalls, business concentration risk. In this particular scenario, we were absolutely able to create wealth personally outside of the business. The business, as far as lack of liquidity, we created liquidity because he's able to infuse capital back into his business. Instead of borrowing other people's money and or the cost of capital, he is utilizing his own bank per se. We've removed the tax rate risk because if tax rates are higher as he looks forward in the future and he goes to retire, he has a tax-free income stream and or a bucket of money that he has transitioned into a tax-free environment. And lastly, we've removed any trapped wealth inside the business. What's great about this particular tool is he gets to make his own determination as he implements his succession plan as to whether or not he sells the business. He's not forced to sell the business to create liquidity. So again, this particular situation is not going to match yours exactly, but I think what you can see by our strategy that we've created today is we have the ability to address these 7 small business pitfalls of capital. Now, I'm going to transition this over for a Q&A to our founder, Kerry, CEO, and Todd Plyman, managing partner of Reuben Brown. I hope you've enjoyed our conversation today. If this is of interest to you, please talk to your advisor that invited you. Thank you very much.
Good afternoon, Todd. How are you today?
Doing well, Kerry. Thanks for having me.
So with me today is Todd Plyman. Todd is the local managing partner with Reuben Brown. Todd, would you spend just a minute or two talking about Reuben Brown and your role here locally here in Kansas City?
Sure. Reuben Brown, we're a full-service CPA firm and a consulting firm. We do audit services, tax services, and consulting services for our clients. And that clientele is mainly made up of good middle market, closely held businesses. So we're working with a lot of business owners on their personal needs as well as the corporate needs.
So Todd, you've done this for about 30 years. When I looked at preparing for this, you and I together had spent over 60 years working with small, closely held businesses. Would you say in that time frame you've seen things that you would call really good decisions and some that if you got a chance as their advisor you might have done differently or might have looked at differently?
We've definitely seen the full gamut, and you see where, from a personal perspective and from a corporate perspective, what companies have done well and business owners have done well and where they've really struggled.
Yeah, so our goal today is to spend a few minutes talking about capital. And it's one of my favorite topics because capital seems so simple, but with a lot of business owners, it's proper use of capital, spending a minute or two talking about liquidity, and then kind of when we get done, land the plane and talk about situations that can test how you built the business. And today, more than ever before, and I think this is the 3rd time I've thought this in my career, some of the businesses have gone through coronavirus for a lot of feedback nationally with a pretty uncertain future. And so I think it's timely that we talk about this topic. So one of the things that crosses my mind, and we have been in multiple discussions with our team on one of the things that comes up, why do businesses end up having such an over concentration of their net worth or their wealth tied up in their business time.
Yeah, I think there's some multiple reasons for that. Part of it may be just the current status of the business as far as what financial condition they're in, what life stage they're in, where they need a lot of capital. The owner has to leave a lot of capital in the business. I think once you get beyond that point though, many times it comes down to really just lack of planning and understanding. Business owners many times are so focused on the day-to-day operations of the business, they don't step back and take a look at what are really the capital needs and liquidity needs of the business.
So doesn't it seem like that a lot of business owners were worried about surviving initially, maybe in the first phase, and then they get past that mode, and the more they grow, the worse the problem gets. It's really hard to create net worth outside of the business. So by the pure nature of their own success is what creates their risk to both the business and their family. It's ironic, but the success creates it, and it's really hard to de-risk or change that if they're not pretty intentional. I mean, in our experience. So in your experience, what are the most common mistakes when they look at capital or free cash flow that you see? Tell me some of the things. There's probably 2-3 categories that you see most common in your consulting.
Sure, I think a few things come to mind. First off, a lot of times we'll see extremes. Either they're not leaving enough capital in the business, and the business is very cash strapped. They're pulling out every dollar that it generates, or many times they're leaving way too much money and capital into the business, and there's risk involved in that as well. From the fact of, are they getting the best return on their money? Because if they're leaving it in the company and it's just sitting in a money market, what kind of return is that getting? As well as the legal risk. If you've got a lot of excess capital in the business, is that the right place for it?
Yeah, so don't you think that it seems like a lot of business owners ultimately build a business to support their lifestyle?
Yes.
So yes, I do think it's that cash flow, but I think people in businesses that we consult with frequently didn't do well in the beginning, and they kind of have this perspective of, I kind of want to live the way that I want because I've waited a long time to do that. Sometimes they don't know that those decisions become connected. So lifestyle and proper use of capital sometimes they're not congruent. And there should be a formula, you would think, of how much cash you need and lines of credit and other things that are there. But in our view with our team, sometimes it's tied to what the owner wants in terms of a lifestyle choice, not so much strategically what would the business need both in good and bad times.
I would agree, and I'd say a lot of times it's lack of planning and lack of forecasting, both from the corporate side and the business side. You look at it from the corporate side, what do they need for working capital, daily operations? What do they need for capital expenditures? What do they need for acquisitions and growth and rainy day and those sort of things? And then from a personal side, stepping back and looking at it, what do they need for their lifestyle? What do they need for retirement? Legacy and family, charitable operations, and also just excess money to have if they need to reinvest back in the business. And I think so many times they don't step back and really understand what each of those look like, both from the corporate and individual side, and forecast and budget that out.
So I think I've kind of heard your answer, but how important do you think looking at liquidity is versus capital? Because those access to capital and liquidity are not the same thing.
Right.
But a lot of times it feels to me like that many business owners don't look at liquidity as both a way to de-risk the business and an amount that's ideal. What is your kind of view on that?
I would agree, and I think many times they don't understand what their true liquidity needs are. Looking at this businesses that are up and down based on seasonality and other flows of the funds through the business, they don't really understand when are those needs most prevalent and what do they need to prepare for that. And so I think that really puts them in a really tough situation, especially when we see downturns that we have right now, versus having excess capital to do acquisitions, to fund growth and different things along those lines.
So our nation is, by most measurements seen over the last 5 to 7 years, maybe since 2008, depending on your view in the sectors, incredible growth in almost every business out there. What we've seen is expansion. We've seen businesses adding employees. We've seen them adding locations, buying other businesses. when all those things happen, people start looking at liquidity different because they use it, frankly, at times they shouldn't. So one of the things that I look at with the coronavirus is how sudden that a lot of businesses realized that they had a new normal. And I really don't like that phrase, but it's let's throw a new business cycle around.
Sure.
How prepared do you think most people were for the suddenness of this change? And how much was there a hangover from all the expansion that had come before that and what you see in your own view?
Yeah, I would say most were not prepared. And again, many times the business owners are doing it by a gut feel versus sitting down and truly mapping out what that looks like. And then also you talked about the growth and expansion. I think many times business owners underestimate what the real needs are, liquidity needs to do that. So it's not only making the acquisition or adding a product line, it's after that. What additional working capital do you need at that time? What additional funds do you need just to generate the growth that you need from those recent acquisitions that you did? And so again, they look at, okay, this is going to cost me X to buy this, but they don't really think through the after effect of that and what's needed. Then you ramp on top of that, the pandemic, and that just really throws a wrench in the whole thing.
It's unusual that you would say, I never planned on a pandemic happening in my business.
Yeah.
But yet there are headwinds and storms that come all the time. This one was more sudden, and certainly for most, there's no way they could have known it's coming, but business cycles certainly change, expansion and contraction. So one of the things that I contemplate through this, I've had several businesses that were planning on exiting. Usually, I'm going to use my phrase, you're going to look at it probably differently. They're going to get paid $1 gazillion. Usually it's the private equity firm that has a lot of money that's going to pay more than anybody else. And so what they don't think through is in the wrong set of circumstances, they can't exit well. They can't be able to create the liquidity for their family. So as you look at these businesses that generally a lot of their net worth is tied up inside of it, and maybe arguably their family future, charitable interest, what do they do to de-risk or protect against this single life decision that affects so many things?
Yeah, well, I think a few things they need to be thinking about. One, they need to plan and prepare for that exit. So many times they're procrastinating on that, and they keep pushing that can down the road as far as getting ready for that situation. And that's something that needs to really happen 3 to 5 years out. And many times we see it where they'll just get an offer, or they hear a friend get an offer, and it's like, oh, well, maybe I should sell now. And they haven't done the things that they need to, both from the financing side of things, the cash flow side of things, and also preparing the business to be ready to be ran by someone else. And they think about it from their perspective versus the investor or acquirer's perspective. And so that really puts them in a situation where they're not going to maximize the value because they're not prepared for it.
So today, part of what's going on is we're talking to businesses about corporate capital, use of corporate capital. I would imagine that a lot of businesses are going to be a lot less creditworthy for at least the foreseeable future. Banks are going to look at risk differently, I think. Matter of fact, I've heard that we've been fortunate enough to have great banking relationships over the years. But I think that's going to be a different cycle for a lot of people that they're not accustomed to. We saw that in 2008 where people couldn't get a hold of capital that needed it. But as we sort of land the plane for the few minutes we're talking today, and we think about both expansion, contraction, capital, and time together, what would be some of your most important lessons? And I think you've said a lot of them, but I just want to summarize at the end that as a result of your COVID experience, both living through other businesses and cycles, that would be some of your major takeaways of number one in capital, and number two, just good solid practices that a lot of business owners could use now to not be so tied up together in a market cycle that is difficult to react to. What would be 2 or 3 things that are your highlights? Because you had some great comments, so I would really appreciate.
Sure. Yeah, I think it's planning and forecasting from the corporate side and the individual side. Then I think it's stepping back and looking at what are your options and opportunities for capital. Obviously, there's the capital in the business, there's personal resources, there's financing like we talked about, there's external investors, and I think it's having those resources, A, understand what they are, and B, have those relationships in place so that you are able to draw on those when situations like this come up.
Yeah.
And I think so many times, again, they're focused on the day-to-day operations of the business, and that they may not need a whole lot of excess capital right now, and they're not thinking of all those other options that they have to prepare themselves when you know, the pandemic or other issues like this come up.
So one of the things before I close that crosses my mind, it seems like business owners in total, and maybe this is just my own experience, seem to have more health problems than some of the other communities that we deal with. And I don't know whether it's stress or lifestyle, but a lot of times we get the call of, I need to do something soon because they've had something that has at least threatened their world or made them hit pause. So if you would turn this around a little bit and say, you know you're gonna have to exit, whatever exit means to you, you can plan an exit, and the phrase we use, exit well. You can move money outside the business and be able to have net worth that's not tied up in the walls, even though it might be a higher rate of return. And in some ways, you'll have less stress and anxiety in your life by planning well. Planning well, these are one of the phrases we use, leads to exiting well. Lack of planning ends up leading to anxiety. And frequently stress, at least in my own life, Todd, I create most of my own. Sound familiar?
We're all guilty of that. And the other thing is, on the planning side, it's not only from the true cash flows, it's also what's the best way to plan from a tax perspective. So many times they don't think through that side of it, both from the corporate side and the personal side, and what is the best way to handle that situation for yourself. So there's so many things that go into it, and like you said, that planning makes all the difference in the world.
Well, Todd, we're out of time for today. On behalf of my friendship with you and Prevail, thank you for spending a few minutes with me this afternoon. I truly hope we can impact somebody's life on how they run their business and ultimately maybe their family as a result of the time and the input. And we will furnish both your contact information and a little bit about your firm in this as well. So Todd, thank you so much. We don't get to shake hands anymore, but thank you for the time that we spent together today.
Thank you, and thank you for doing this for the business community and all the investors in the community, because this is a very important topic that so many people do procrastinate on, and so I think you're doing a great service to your clients and to the Kansas City community by doing this.
Thank you, Todd. Thanks a lot for your time today. Appreciate it.
So from all of us here at Prevail, thank you for spending your lunch break with us. We hope this 30 minutes was of value. Thank you to our presenters, Andrew Stafford and Kerry Lying. Huge thank you to our special guest, Todd Plyman of Rubin Brown. We appreciate you giving us your time and expertise today. I encourage you to reach out to the advisor who invited you to this event if you have questions or if you're ready to get started planning your own new corporate capital strategy. You can also find more information and education from us on all the social media platforms and online. Especially our YouTube channel has a wealth of information to explore. If you don't have an advisor of your very own, you can reach out to the corporate office with the email address or phone number listed here. Thank you again for spending your time with us. I hope to see you all again very soon.